Your signature on a tax return, it's your seal of approval, right? It's your promise. But what happens when the IRS decides they want to take a closer look at your work? Today, we are going to build a due diligence process that can actually stand up to that kind of scrutiny. Man, that is a line that just sends a shiver down any preparer's spine. It's that instant pit in your stomach, that feeling of, oh no, what did I miss? This is a real quote from a preparer who was facing an examination, and it just perfectly captures the high stakes of what we're about to get into. Let's get one thing straight right away. This is not some optional best practice. Due diligence is a legal requirement from the IRS for some of the most common tax benefits out there. And getting it wrong? Well, the consequences are severe. We're talking about a hit to your wallet for sure, but also to your professional reputation. Okay, so if we're gonna build a bulletproof defense, you first have to understand the rules of the game. So let's start with the mandate itself. What exactly is the IRS demanding when they use that term due diligence? This whole thing gets triggered by some of the most common credits and filing statuses you deal with every single day. We're talking about the big ones: the Earned Income Tax Credit, the Child Tax Credit and all its variations, the American Opportunity Tax Credit for college, and even the Head of Household filing status. If you're preparing a return with any of these, guess what? The due diligence rules apply to you. And here is the number that really gets everyone's attention: $650. Now listen, that's the penalty for each failure to meet the requirements per credit or status. So think about it. If you mess up on a return that claims EITC and Head of Household, that's 2 failures, right? You can see how this can multiply across a single return and then across your entire client base really, really fast. So how do you avoid those penalties? Well, the good news is the IRS has laid out a pretty clear framework. Let's break down the 4 foundational pillars you need for a compliant and, more importantly, a defensible due diligence process. The easiest way to remember this is just as a 4-step process: complete and submit, compute, know, and keep. It's a simple little mantra for the core actions you have to take on every single one of these returns. So let's dig into what each one of these really means. First up, complete and submit. This one is completely non-negotiable. Form 8867 is your official statement to the IRS saying, yes, I did my due diligence. It's not just another piece of paper to file, it is literally the start of your defense. It has to be filled out accurately and sent in with the return, no exceptions. Second, compute. You have to show your work. It's like back in math class, right? This means you have to complete the necessary worksheets for whatever credits are being claimed. That final number on the tax form, it needs a clear trail of calculations that back it up. This proves you didn't just pull a number out of thin air or use one the client gave you. Okay, this next pillar, the knowledge requirement, this is where the real risk is. In fact, something like 90% of penalties come from failures right here. This rule means you cannot just be a typist, simply entering what the client tells you. You have to be a reasonable skeptic. You have to ask more questions if something seems inconsistent or just off. And finally, keep. You have to maintain a defensible paper trail for 3 full years. This means a copy of that Form 8867, all the worksheets, and, this is so critical, your notes that document the questions you asked and the answers your client gave you. This stuff is your evidence if you're ever questioned. So that knowledge requirement we just talked about, that's where theory crashes into the messy reality of people's lives. Let's dig into some of those tricky client situations that live in the gray areas. You know, year after year, it's the same issues that trip up preparers. Things like confirming a qualifying child's relationship and especially their residency. Validating that head of household status, particularly when there's a recent separation. And of course, verifying income for self-employed clients on a Schedule C. These are the big red flags where you have to slow down and ask more questions. This right here perfectly illustrates the kind of shift in thinking you need to have. A client says something simple like, my nephew lives with me. You can't just stop there. You have to ask, Okay, but do his parents have the right to claim him? Where did he live for more than half the year? Or they say, we separated. You have to dig deeper. What date did she move out? Are we talking about two completely separate households now? Your job is to turn these vague statements into documented, defensible facts. So how do you ask these questions without totally alienating your client? You have to be professional and direct. Explain the why behind the question, just like in this script. You can say, look, I know this feels personal, but I'm not being nosy. I'm actually required by the IRS to get this information. Framing it that way really helps the client understand that you're on their side. Oh, this is a question I hear all the time, especially from preparers who've been in the game for a while. You've got a great relationship with a client, you've done their taxes for a decade, and you think nothing's changed. Do you really have to go through the whole song and dance again? The answer is a huge, unambiguous yes. Period. There are no shortcuts. Being familiar with your client does not equal compliance in the eyes of the IRS. You are required to confirm the facts and document your process every single year for every single return. That is the standard. End of story. But what happens if your number comes up? What if you actually get that notice? Let's demystify the whole process and look at the anatomy of a due diligence exam so you know exactly what to expect. It's a very structured, very predictable process. It all starts when you receive an official IRS letter. Usually it's a letter 6222. Then you'll be asked to submit the complete records for about 25 of your client files. An IRS agent reviews all that documentation, and then finally, they'll schedule an interview with you, either over the phone or in person, to talk about your process. And this right here, this is the single most important, non-obvious insight into this whole thing. An IRS agent will literally tell you this. They are not auditing your clients. They are auditing you. The focus is 100% on whether your firm followed the 4 due diligence requirements. That's a huge shift in perspective. So the agent's goal is to figure out if your errors are just a fluke or if they're part of a pattern. If they look through those 25 files and see 1 or 2 with some minor issues, you'll probably just get some education, not penalties. But if they see the same mistakes over and over again, they're going to conclude that this is just your standard operating procedure. And that's when the penalties start flying. Which brings us to our final, and honestly, our most important section. How do you make absolutely sure that your firm's standard procedure is rock solid? Let's build your compliance playbook. All right, here are the best practices you can start using today. Make regular due diligence training mandatory for everyone. Document every single client answer to every single question. Have a second person review complex or weird returns. Don't be afraid to escalate a questionable file to a manager, and you have to be prepared to fire a client who gives you sketchy info. And hey, use the free resources out there, like the IRS Tax Preparer Toolkit and their online training. You can even get CE credits for it. So, we'll end with this. Your signature is your promise of accuracy, of professionalism. When you sign that return, you're not just endorsing the numbers, you're vouching for the entire process behind them. So the question you have to ask yourself is your process strong enough to defend?